Is the worst really behind us?
Well, I don't know if the worst is really behind us or we're just having that sort of usual January effect where you get that sort of worst to first kind of action after tax loss selling and reinvestment in some of the most beaten down sectors. That seemed to be the genesis of that at the beginning, a couple of weeks of the year. Now things seem to sort of be juxtaposed against the fact that positioning was wrong-footed coming into the year as well. So the hedge fund short position has increased significantly over the course of the last 3 weeks. It was low coming into the year, so you've got that pressure as well. The greater the these rallies become, the more these shorts get squeezed. And I think that the third thing really is that the parade of Fed speakers, which is thankfully behind us until the next meeting, has really choreographed a message that they're going to slow down and they're close to their pause. And I think that's helpful for the market too. I think that sort of acts as a tailwind. If we're within shouting distance of the Fed not raising rates anymore, finding that terminal rate and staying there for a period of time, I think the markets would breathe a sigh of relief there and likely rally from here. So I think all those things are playing into it. Some of the rallies that we've seen, like Nvidia, for example, is news related. It's been deemed the picks and shovels, as Katie said, of the AI movement, and we'll see if that has any legs to it. But I clearly think that a lot of this is really just what was the worst performing sector last year? Let's dive into that. What was the best performing sector? Let's use that as our ATM for that sponsorship. So you're seeing energy down, materials down, consumer discretionary doing better, tech and communication services doing better.
Art, two things. Number one, I really like the constant drip of Fed speak. I can't wait until next Monday. Number two, I want to talk about that last point you made, that people seem to be diving into the most beaten down sectors. It seems like tech is the beneficiary of that. Is this all valuations, or again, kind of to Romaine's first question, has anything fundamentally changed?
I think what's fundamentally changed, Katie, and I think you're right. I too am a big fan of the constant drip of Fed speak. But I think that really, when you get to the basics of this, we clearly did a lot of multiple contraction over the course of 2022, entering 2023, especially in the most speculative fringes of the market, right? So, clearly, you see some of these, security software names that are still down 60, 70, 80%. So, taking a shot at that in a new year with new money, clearly is one of the drivers. But what we won't know until we get through this week and next, when we'll have about half of the S&P 500 reporting, is if actually the sponsorship of the beaten up technology and communication services stocks actually makes sense when we get earnings reported and we get guidance for 23. I think that'll give us a better picture. So we tend to get a dissipation of this January effect once we sort of get into the heart of earnings season, and that really kicks off this week and next.